Hi, I'm Aradhna Agarwal. I am a CPA, and my goal is simple to help everyday people understand taxes without fear, confusion, or jargon. Today, we are diving into something every taxpayer should know about the common red flags that could put your tax return on the IRS's radar for an audit. Now, before we begin, remember that filing an accurate and honest tax return is always your best defense. But understanding what triggers additional scrutiny can help you prepare better documentation and avoid unnecessary stress. Red flag number one is unreported income, and this is the big one. The IRS receives copies of all your W 2s, 1099s, and other income documents. They have sophisticated matching systems that compare what's reported to them versus what's on your return. This includes freelance income, side gigs, investment earnings, and even the money you made selling items online. If there's a discrepancy, you are likely to get a notice and potentially an audit. Keep meticulous records of all income sources, and if you receive a 1099 for income you didn't actually receive, don't just ignore it. Report it and then show the offsetting entry. Red flag number two, claiming business deductions that are disproportionate to your income or industry norms. The IRS looks at ratios. If you are reporting $50,000 in business income but claiming $30,000 in business expense that is not standard for your industry, that will raise the eyebrow. They have industry averages for different professions and business types. Common problem areas include home office deductions that seem too large, excessive meal and entertainment expenses, personal expenses claimed as business expenses, vehicle expenses that do not match business use. Remember, every business deduction must be ordinary, necessary, and directly related to your business. Red flag number three, charitable deductions that are unusually large compared to your income. The IRS has statistics on average charitable giving by income level. If you are claiming charitable deductions of $15,000 on a $75,000 income, that's going to get attention. Key points to remember: keep all receipts and acknowledgments. For donations over 250, you need written acknowledgement from the charity. Non-cash donations over $500 require Form 8283. Get qualified appraisals for high value items. And please don't inflate the value of donated items. That bag of old clothes to Goodwill may not be worth $2,000. Red flag number four affects cash intensive businesses, restaurants, hair salons, taxi services, and retail establishments. The IRS knows these businesses handle a lot of cash, making it easier to underreport income. They pay extra attention to businesses with high cash volume but low reported profits, inconsistent profit margins compared to industry standards, large gaps between gross receipts and bank deposits. If you run a cash business, maintain detailed daily sales record, make regular bank deposits, and consider using point of sale systems that create electronic trails. Red flag number five, claiming business losses year after year, especially for side businesses or hobbies. The IRS has something called the hobby loss rule. If your business does not show a profit in at least 3 of the last 5 years, they may classify it as a hobby and you cannot deduct any losses. This commonly affects consulting businesses with minimal income, horse breeding, or racing. Any business that looks more like a personal interest. To avoid this, maintain professional business practices, separate business accounts, business licenses, marketing efforts, and detailed profit and loss projections. Red flag number six seems basic but is crucial: math errors. and internal inconsistencies. Simple addition errors can trigger computer audits. More seriously, when numbers don't add up across different forms like Schedule C income not matching what's reported on your 1040, the IRS takes notice. Always double check your math, use tax software when possible, and ensure consistency across all forms and schedules. Red flag number 7, simply making a lot of money. The audit rate increases significantly with income. This isn't necessarily fair, but it's reality. High earners need to be extra diligent about documentation and consider professional tax preparation to minimize risk. Now, let's talk about prevention strategies. First, documentation is everything. Keep detailed records, receipts, bank statements, and any supporting documents for at least 3 years. 7 years for significant items. Second, be conservative and honest. When in doubt, err on the side of caution. The few dollars saved on aggressive deductions aren't worth the audit risk. Third, use qualified tax professional. A good CPA or enrolled agent can help you navigate complex situations and reduce audit risks while maximizing legitimate deductions. Fourth, file electronically and on time. Late filings and paper returns get more scrutiny. Fifth, if you do get audited, don't panic. Respond promptly, provide requested documentation, and consider professional representation. Remember, the goal is not to be paranoid about every deduction, it is to be informed and prepared. Honest taxpayers with good records have nothing to fear from audits. The key takeaways: keep excellent records, be honest and accurate, understand what triggers scrutiny, and when in doubt, consult a professional. Thanks for watching, and remember, good tax planning happens year round, not just at filing time. See you next time, and don't forget to like and subscribe for more tax tips that are legal, practical, and intentional.